Following video is an excerpt from a CSI Live July 22nd, 2026 I did with my friend Jason Hall from Investing Unscripted. We did this right on the cusp of the unwinding of the memory momentum trade. This is an important one. Make sure you follow this one closely. It could help inform you on what you want to do, if anything, if you've participated in this memory stock craze of the last 6 months especially. And make sure to check us out at chipstockinvestor.com. Semi-Insider, we have weekly events like this where we talk about things in tech and technology investing and get ahead of these big events before they actually become mainstream news. We think this is highly important today. You're bombarded with so much information and the majority of it is not important to you as an investor. We'd like to help you cut through that noise and be a trusted resource. Check us out, chipstockinvestor.com, and pay close attention to this video with Jason Hall from Investing Unscripted.
There are times when price taker businesses are caught up in such an incredible opportunity where supply is constrained and they're one of a handful of suppliers where they're making money that these businesses have never made before, and they can look the cheapest right when they're the most expensive. And we can see things happen that upend that opportunity, more supply coming online. I think we can kind of see what's happening with supply pretty good. ASML is telling us what's going on with them. Memory is huge opportunity for them to deploy machines. Micron is telling us what their plans are for CapEx spending. We know what's happening, but here's the bottom line. Some really smart people probably knew 2 or 3 years ago that there was going to be a bottleneck in memory. If you're deep in this and you've been paying close attention, you're like, these stocks are absolutely going to go up a ton because memory is going to get constrained, prices are going to go up. And these aren't just going in data centers for training LLMs and inference. It's affecting Apple. Advanced compute is being affected here. But the point is that it's awesome when the music's playing, but the music always turns off when everybody's a little bit drunk and nobody's expecting the music to get turned off. And the downside can be really quick with these. And if you're jumping in now, anytime over the past few months, you could make some pretty decent money over the next couple of years. You could also lose half of it very, very quickly. It's probably the best way that I think about when it comes to these momentum opportunities. If it's something that you know absolutely nothing about, an industry that you don't follow, and you're learning about it from a guy in a Bob's Big Boy hat on a live stream really for the first time, there's a very good chance that the risk is bigger than the opportunity for you as an individual investor. And that doesn't mean you should stay away from it, but it means you should be aware of things like position sizing to reduce your downside risk and not risking money you can't afford to lose to make money that you don't really have to make. That's really the way that I think about it.
And sizing is one of the unsexiest, grossest topics to bring up in a conversation like this. That's why it's so important, is because no one wants to talk about it. It's no fun talking about risk management, but this is what especially the people that control the world's capital talk about all the time, is risk management and right-sizing a position so that you not just make great money, but stay in the game for a long time.
Yeah. And one of the tools that I use, FOMO, leads to massive losses over time because you feel that pull. But the inverse side of the FOMO coin is regret minimization. I can't miss this. I've got to get involved in this. That's FOMO. The other side of that is future you looking back at present you and saying either, man, what an idiot, or man, I'm glad you thought that through. So envisioning future you, looking back at your decision today based on the outcomes. Obviously, we're going to think of it in a binary way. Either I made a bunch of money or I lost a bunch of money. There's somewhere in between where it works out okay, or luckily you walk away without losing a bunch of money, but you didn't make any. There's a spectrum of outcomes, but being able to look 5 years or 10 years and imagine future you looking back at today and saying, okay, this is the outcome that happened. How would I feel about it? And you might envision future you looking at you today and saying, you know what? I lost $5,000, but I'm okay with that because I could afford to lose $5,000 on that specific opportunity because I had enough diversification everywhere else that this wasn't going to upend the apple cart and my kid's still going to be able to go to college or whatever you want to do with your money. So that's the other side of that coin that I think is really useful. That's about as sexy as position sizing, isn't it?
Yeah, that is a much sexier way of thinking about position sizing.